Venture capital and venture debt are two widely used financing options for startups, each serving distinct purposes and offering unique advantages. While both can provide essential capital for growth, they differ significantly in their structure, terms, and implications for founders and investors. Venture debt is a form of non-dilutive financing that provides startups with capital in the form of a loan rather than an equity investment. It is often used as a supplement to VC funding, allowing startups to extend their financial runway without giving up additional ownership. Unlike equity financing, venture debt comes with fixed repayment terms, interest obligations, and potential covenants that require startups to meet certain financial metrics. This type of financing is particularly useful for startups that have already raised venture capital but need additional capital for specific purposes, such as funding inventory, covering operational expenses, financing acquisitions, or bridging the gap between equity rounds. Venture debt can also be a strategic tool for startups looking to fund short-term growth initiatives that have a clear path to generating revenue. While venture debt helps founders retain more control over their company, it also introduces financial risk, as startups must ensure they can meet their repayment obligations even in times of market uncertainty. If a company struggles to generate sufficient cash flow, taking on too much debt can lead to financial strain or even insolvency. Therefore, startups need to carefully evaluate their ability to manage debt before opting for this financing option. Venture capital, on the other hand, involves an equity investment, where venture capitalists provide funding in exchange for ownership stakes and the potential for significant financial upside. This form of financing is ideal for high-growth startups that require substantial capital to scale their operations, expand into new markets, or develop innovative products. VC-backed companies benefit not only from funding, but also from strategic guidance, mentorship, and access to an extensive network of industry experts and potential partners. Because VC funding requires giving up equity, founders experience dilution, meaning their ownership percentage decreases with each investment round. However, this trade-off is often justified by the opportunity to accelerate growth at a pace that would be difficult to achieve with internal funding or traditional loans. Venture capitalists are typically involved in the long term, offering expertise in scaling businesses, navigating competitive landscapes, and preparing for future funding rounds or exits, such as acquisitions or IPOs. When considering how startups secure funding, it is important to understand the key differences between venture capital and venture debt. Venture debt functions as a loan, enabling startups to secure additional capital without giving up ownership. However, it comes with the obligation of regular repayments and requires strong financial discipline. Venture debt can be a useful tool for extending a company's runway or financing specific initiatives without diluting existing shareholders. Contrary, venture capital provides funding in exchange for equity, offering startups not just capital, but also strategic guidance and valuable industry connections. This type of financing allows startups to pursue ambitious growth plans, innovate at a high level, and access networks that can accelerate their success. Both financing options can be used together depending on a startup stage of development, financial strategy, and growth objectives. While venture capital is generally better suited for long-term expansion and high-risk innovation, venture debt is often employed to meet short-term financial needs or to improve capital efficiency without compromising ownership.